Hi, I'm Samantha Fitzpatrick, co-manager of Murray International. In terms of the highlights from last year, we actually focus on how well we have met the investment objective, and there's different component parts to that. So the first bit is delivering an above average dividend yield compared to our peers, and we did manage to achieve that and that is linked to that very strong share price performance last year. So we ended the year with a dividend yield of 3.7%, which is at the lower end of where we've been historically. So the underlying yield, the running yield of the portfolio is still as it was, about 4.4%, but that dividend yield itself has come down a little bit. In terms of dividend growth, we aim to deliver real dividend growth for our shareholders, and we did achieve that last year. The dividend growth was 5.1% versus 4.2% for the UK RPI. And we did deliver 21 consecutive years now of dividend growth, which is very pleasing, but it's great to get back to that real growth, which we hadn't done since 2020 because of very high levels of inflation. In terms of the capital return, we did deliver real capital growth over the past year, delivering a total return of 21.9%. So that was well over inflation, which was a very positive result for the trust. We were also able to put 11 million into reserves, and that's our rainy day fund, which is looking very healthy now at 85 million. The trust delivered very strong returns on a relative basis also. So the 21.9 total return compares to a benchmark return of 12.6% for the calendar year. And there was different parts to that outperformance. Looking at the relative performance in a regional context, the strong contributors there were North America, where the underweight position was beneficial, and also we had very strong stock selection within that category. We benefited from being overweight Asia, and also strong stock selection within that market was very good. And also having exposure to Latin America was a big positive. So this is a very, very small component of really any global benchmark, but we have around 8% of the trust in Latin America, and that was the strongest market category overall last year. So having exposure there was very good. From a sector perspective, it was really broad-based. Actually, we had positive relative returns from every market sector apart from healthcare. That was the one that detracted slightly from being overweight, a relatively weak sector, and relatively poor stock selection within that category, but it was still positive overall. In an absolute sense, returns there were 11% in sterling terms, and even looking at it on a relative basis, it only cost 0.4% of relative performance, but that was the only one. So really pleasing to see the broad-based outperformance across different elements of the trust. The diversification was very powerful last year. If you look through the top 10 top stock contributors, for example, there's a whole host of different types of companies from different regions. So within the top 10 names, we had things like Singtel, a Singapore telecoms company. We had Grupo Asur, a Mexican airport operator, a European utility. So there was lots of different strengths, which was very pleasing. There was some exposure to the US, which benefited returns. So we had strong performance from Philip Morris, a US tobacco company, and one of our US tech stocks was strong, and other elements of tech within Asia also added value over the period. In terms of detractors, there was more of a theme within the negative section. So we had two things going on. Within consumer staples, a couple of our alcohol companies were very weak. We hold both Pernod and Diageo, which were down about 30% last year in sterling terms. And we agonise over these names. You know, we've got lots of things that work, but we absolutely focus on the bottom stocks more. So those are names which are very much under consideration at present. Now, this was offset within staples from strong returns from other areas. So Philip Morris and British American Tobacco within consumer staples were very strong, and that led to the overall results from staples being positive. That was a 12% returning category last year, so not disastrous by any means, but the two alcohol stocks were key detractors. And the other area more broadly that was weak was some of the healthcare names. So names like Merck, Bristol Myers, AbbVie delivered positive returns overall, 11% in sterling terms, but these names were weaker on a relative basis. Partly due to broader issues, for example, tariffs weighed on the stocks quite heavily last year at some points, and regulation, potential change there in the US was also a headwind, as well as some individual stock issues. So some of these companies do face quite significant patent cliffs, and that can be an issue for future growth. So that was a weaker area of the portfolio last year. The trust moved from a discount of 7.5% to a premium of 3% over the course of the year. And that's absolutely influenced by the underlying performance of the trust. It was really, no surprise that net asset value had a strong year, so therefore the share price did also. And I think also just this element of downside protection landed very well in the first part of last year, and then the trust did continue to keep pace as markets rallied after the disruption that we saw in April. And in terms of the asset class more broadly, I think that element of resilience when it comes to income, especially with us trying to deliver a covered dividend, i.e. paying out income from the income generated from the holdings, also was something people liked, just given the huge volatility and uncertainty that we've seen. So for Murray International, us paying our income isn't reliant on share prices going up. It's reliant on the underlying holdings delivering from an income perspective, and that definitely was something that resonated well last year. Thank you for watching. For any other information on Murray International, please visit our website.